I think that this does feel like it's going to be a very bullish equity cycle ahead, and that's why we're constructive. And it's been a rough start for this year, but I think we're just sort of getting through some of the kinks and burning off some of the recent bullishness.
Tom Lee starts by addressing the current economic policies under the new administration, which at first glance seem disruptive but may have long-term benefits. He believes these policies could set the stage for deficit normalization, a critical issue for long-term financial stability. Despite negative consumer confidence reports, he sees signs of returning animal spirits, a term used to describe renewed investor enthusiasm and economic optimism. This optimism, he argues, is backed by tangible productivity drivers, particularly artificial intelligence, AI, which justifies continued capital allocation to equities. One of Lee's most striking claims is that Bitcoin remains his top investment idea for the year. He asserts that Bitcoin will likely outperform all other asset classes, including gold. This bullish stance is anchored in broader macroeconomic trends, particularly demographics.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
From the shorter lens, this incoming administration, I think, is doing things that look very disruptive at the moment, but I think structurally are really positive because it's a path for U.S. deficit to normalize. And I think, indeed, I think animal spirits are coming back, even though things like these consumer confidence reports don't show it. And we know that there is tangible drivers of productivity, including AI, in front of us that justify, investors allocating capital. And of course, there's still plenty of disruption ahead, including crypto. And, I think Bitcoin is still our favorite idea for this year. So we think it'll be the best performing asset class, even better than gold. But I think anchoring all of this is a demographic story. I can send you some charts later, but if we look at the number of people aged 30 to 50 in the U.S., that's actually been steadily rising since 2009. It actually went positive in 2016. And what I mean by that is the number of people aged 30 to 50 matters in an economy because they're the ones that are driving both credit consumption, but also productivity, innovation,
and investment. In the end, I think all of macro is just demographics. By the time, if you do enough work, go deep enough down the rabbit hole, the one monster factor of all is basically demographics.
And then there's a contrast because, as you know, in the rest of the world actually has a depletion of population. And so that's creating the demand for AI workers, which is what the U.S. tech companies are producing. So I think that this does feel like it's going to be a very bullish equity cycle ahead. And that's why we're constructive. And it's been a rough start for this year, but I think we're just sort of getting through some of the kinks and burning off some of the recent bullishness.
Yeah, I'm the same. We get the optimism about Trump, then we get the correction until we get the actual news story. How are you thinking through? I mean, you and I are obviously thinking through the AI in the same way. We're about to produce infinite workers. AI and robots is infinite human intelligence and infinite humans, right? I mean, this completely breaks the economic model. We have no understanding what this is going to do. But let's assume we'll get there whenever that happens. You're starting to even hear Satya Nadella start thinking, and this might be, I want to go back to the psychology of 2000, that many of these people worry about is they're worrying about, have we overbuilt? Or are we overbuilding data? Are we overbuilding chips? Are we overbuilding? I'm not sure that we're not still underbuilding, but we might be scarred. And I haven't decided, but where do you think we lie on this? Is this an overbuild and everyone's going to write off a whole bunch of capital, or is this still too early to say?
People who are going to call the top in data center demand have never really experienced industrial cycles, right? Because the cycles actually are going to extend until return on invested capital is well past negative. And I would be very surprised if we're already reaching that saturation now, because we know that any model today would have improved capabilities if you improved computing power or capacity. So we aren't even experiencing the negative side of that utility yet. So I think that it actually would still argue that you need to be investing more capital. And I know, like when you look at percentage of GDP, I mean, look at what happened with China when direct private investment, it got to 40% of GDP. And that lasted years before you had overcapacity in China. So I don't know how we're even at saturation today in AI, but that's just in broad strokes. So I agree with you. I think there's still a big runway ahead.
Another key point Lee discusses is the evolving nature of capital investment cycles. He references past industry trends, particularly in the financial sector, where automation replaced human traders, yet CapEx intensity in banks increased. This suggests that even as AI replaces human labor, investment in AI infrastructure will continue to expand. He believes the same phenomenon will occur in the AI-driven economy. Rather than reducing investment needs, AI will drive an arms race in computing power, efficiency, and capacity. For investors seeking to profit from these trends, Lee suggests looking for two key analogies in the AI boom. First, he examines historical wireless and fiber infrastructure cycles, noting that stocks in these sectors peaked about 8 years into a 20-year capital expenditure cycle. He predicts that AI-related stocks will follow a similar pattern, with early-stage winners eventually stabilizing as the market matures.
Well, I think it's highlighting two trends. One is they didn't do CapEx, but they did R&D, which until recently was a P&L expense, not a capitalized expense. And so they're supplanting those dollars for capital dollars that become balance sheet assets. In a world of labor shortage, that means you have less OpEx, because that's wages, but you'll have more balance sheet intensity because now you have a computer that you're operating. So I think in a world of labor shortage, balance sheet intensity will go up. So it makes sense that these companies are big spenders of CapEx now. But that does create another wave of innovation, because cooling and power supply and uninterrupted power and all these become strategic advantages, which will create another wave of technology innovation. So I think that there's a lot of opportunity and waves of opportunity being created because of that change that you've just highlighted.
Yeah, I think you're right, because it's going to be a game of efficiencies, because the cost of these models is going down fast, and the compute is going down, but therefore they can increase output. So it's just this tremendous race to get more efficient at every single component part of that flywheel, from energy to chips to compute.
Yes. And we've even seen it in the financial industry. The financial industry used to trade labor intensive, so had a lot of traders and people. And then they replaced all the traders with computers. But someone naively might have said, well, then financial companies' CapEx will go down because they already have computers trading for them. No, CapEx intensity and tech intensity of the banks has actually only gone up since then. So that arms race, without even AI, is consuming more dollars. And that's, of course, I think going to be the case with AI itself.
Putting your stock picking hat on, how do you pick through what is going to win in the next few years? Because, yeah, sure, we can, sure, Microsoft will do fine, et cetera, but how do we make money out of this? And it's not very clear yet with AI, outside of NVIDIA and a few other stocks, how to really make money out of this, out of robotics. A lot of these kind of exponential age technologies, pretty tricky because not much around. There's pretty slim pickings because there's been no IPO market for bloody forever.
I've got two simple analogies to share that I think we should be looking for in AI. So we just published a study looking at the wireless fiber boom and when the stocks peaked relative to capital spending. And many people, so let's say it was a 20-year CapEx cycle for fiber and wireless. The stocks relative to the broad market peaked 8 years into the cycle. So in other words, like halfway into the cycle, the market will suddenly say enough capital has flowed into the space that they're market performers. However, in that now in retrospect, the 25-year look back, one industry in wireless pulled away from everything. Two did. The first one is the tower industry. It has produced better returns than handset, chips, carriers, spectrum owners, the towers, and it's, as you know, it's a boring business that grows in a unit with demand. The second, of course, was Apple came along, but in 2007, so 13 years into the industry and after the industry's stocks all peaked, Apple came in and essentially gobbled up the economics of the ecosystem. So I think that in AI, it'll pay to look for the tower equivalent and the next iOS that'll come out on top of everything. But I think the second thing that's going to be important is that you just described it. AI is infinite workers with PhD qualifications.
Today. Don't forget, in 2 years' time.
Yeah, it'll be super intelligent, right?
Super intelligence. Something we've never had before.
Correct. And yet, these super intelligent entities have to eat pizza. And what I mean by that is like the best performing stock in the last 25 years is Domino's Pizza, because everybody has to eat. So if you could find the pizza of the AI worker, so that's not the infrastructure, it's what you have to feed the worker, that's another moneymaker. And I don't know what that is going to be.
He highlights the most lucrative subsectors within past investment cycles. In wireless, the biggest winners were infrastructure providers, companies that own cell towers. Similarly, in AI, investors should look for the tower equivalent, companies providing essential infrastructure rather than those directly producing AI models. Additionally, he points out that Apple emerged as a late-stage winner in the wireless boom, suggesting that a yet-to-be-identified company could dominate the AI space in a similar fashion. Lastly, Lee introduces an intriguing investment philosophy, finding the pizza of AI workers. He uses Domino's Pizza as an analogy, explaining that despite massive technological changes, certain basic needs like food remain constant. Please like and subscribe.